right. Welcome, everyone. This is episode one of the AVID Investor Podcast, and I'm your host, Josh Adamek. We're going to dive into a lot of details here over the upcoming episodes. We're going to focus on real estate, investing, wealth management, finances, entrepreneurship, business, things like that. Who knows where we're going to go from there? But as we get started, as we get kicked off here, I just want to spend this first episode and tell you a little bit about myself, in case you don't already know, who I am, where we're at, how I got started in the business, and how we progressed and grew the business over the years. So here goes. I am the owner and founder of Adamek Ventures and AVID Management Group. We currently operate under a private equity model where we work one-on-one with private and institutional investors to create and manage portfolios. We primarily invest in single-family homes. We create portfolios of existing single-family homes. We do some new construction, some infill development, some land assemblage type deals, but the bulk of our business is portfolios of single-family homes. So, and again, that's under a private equity model. So how I got started in the business goes back almost 20 years ago. I grew up, in a middle class, lower middle class family. Like a lot, most other families. There's challenges, there's issues along the ways. There's things to deal with. Me personally, lost my mother when I was young, when I was 9 years old. And then, my dad was left to raise two kids. So, he did what he had to do. He worked multiple jobs, did his other, things. He was there, but, he wasn't around much. So he was always working. So we kind of found our own way. My sister and I, she went one direction, I went another direction. I was more, business, entrepreneurial. I always had a vision from a very, very young age that, I wanted to do big things. I wanted to create something big. In my younger days, when I was in my teens, into my early 20s, I thought I was going to find that growth and that prosperity in the automotive industry. So I spent almost a decade in the automotive industry with a vision that, I'm going to grow a brand, establish a brand. We're going to, I was big into custom cars. We're going to follow something similar to like West Coast Choppers, West Coast Customs, build all these crazy custom cars, for athletes, celebrities, things like that. That was my vision, in my teens and into my 20s. And then in my very early 20s, my wife and who's my girlfriend at the time, we were living, in a $350 a month apartment. And I say that because I want you to know, where we started, where this came from. So we're living in an apartment. It was $350 a month, because that's where we were at. That's what I could afford at the time. And again, we're going back almost 20 years ago. So we're living there. There's 4 apartments in the building. Landlord comes by, collects the rent. I give him my rent. The lady next door pays her rent. The people downstairs pay their rent. The other guy downstairs pays his rent. And then he spends the afternoon hanging out with the guy downstairs, drinking a couple of beers, having a good time. And I'm up there. I start thinking about it, and I'm like, that really hit. And the landlord, he's a relative of mine at the time, and I kind of knew the other things that he was doing. He was actually doing some retail project, some retail deals, some what we call flips. He was doing some other investments, and I knew a little bit about it, or I thought I knew a little bit about it. I start doing the math on, what he collected in rent, asking him questions about his other projects and things like that. I start doing some math, and I'm like, man, there's a lot of money in this business. And so it all kind of clicked, and I'm like, I'm gonna buy a building. I'm like 20 years old. And so I bought a book, at his recommendation. I bought a book. I read a book. First book I read on real estate and investing was Fast Cash by Ron LeGrand. Never forget it. Book's still applicable today. The principles in the book, of course, the numbers that they that they reference in the book are drastically different, but the ratios are the same. So that was the first book that I read. At the time, I also linked up with the organization called Acre of Pittsburgh. It's a real estate investors association. I started going to their monthly meetings, linking up with some people, asking some questions, learning as much as I could. And, you know, fast forward 20 years later, I'm on the board with Acre. I have been for over a decade. I volunteer to help run the organization and kind of give back to where I started. So, but anyways, at the time, I read, I read the book. I'm going to these meetings. I'm like, I'm gonna start making some offers. I linked up with a real estate agent, started making some offers, found a property that I wanted. I honed in on it, made an offer month after month, week after week. And finally, 6 months in, they accepted my offer, which was at the time about half of the list price. It was a duplex down the street from where we lived, in that $350 a month apartment. So they took my offer, and great, offers accepted. Now it's like, all right, cool, I got the deal. What next? So I had to figure out how to finance that deal, how to get the money in place, to buy it, to renovate it, and ultimately to get moved in. So that was a whole nother learning curve for me at the time. But we did it. I did it, made it happen. We moved into, fixed up one apartment, moved in, fixed up the other apartment, rented it out. And then the interesting part, I'll never forget this, is rented the first floor apartment for $500 a month, which covered my mortgage payment of $500.60 per month. I'll never forget that. So 21, 22 years old, whatever it was, we were living for free. So now they call it house hacking. There's a term for it, that some of these gurus sell and pitch courses on. Me, I just call it living for free while some other dude paid my mortgage. So that was the start of it. From there, once I saw those numbers and everything clicked, started buying some more, kept going, over the next, 6, 7 years, built up a small portfolio of rental properties, mostly single family homes. 1 or 2 years in, we realized, that didn't want to live in that part of town. So did the same thing, bought a house out in the suburbs, fixed it up, refinanced it, rented out the other apartment. And guess what? That other apartment covered the cost of the new house in the suburbs. So, it's kind of how we grew and progressed. And then, like I said, over the next 6, 7, 8 years, kept building up a small portfolio. And then it got to the point where I'm working full time. I'm still, in the automotive industry, working 50, 60 hours a week. And then early mornings, nights, weekends, whatever it took to grow the business, grow the real estate. That's what I was doing. So I don't even know how many hours I was putting in, but it was a lot. And it all came to a screeching halt in 2010, when my wife was diagnosed with a rare form of breast cancer, triple negative breast cancer. So we get she gets hit with that, we get hit with that, whatever. And here I am working, almost 2 full-time jobs, trying to manage that, balance that. And now my wife's sick. She's going through treatments, there's doctor's appointments, there's things like that. And trying to be there as much as I can. I wish I should have been there much more than I was, but trying to balance and manage all that. So came to the point where the realization where I think, I'm at a point in my career, it's like, I think I know enough about real estate where I can make this my full-time gig. And, but, I got this job, this full-time job with benefits and everything like that. So that was the deciding factor that, I needed to free up some time. Something had to give. So in 2010, I quit my full-time job, and went full-time in real estate. So that's when I made the decision, not because I was making enough money in the real estate to replace my income, but because I thought I knew enough about real estate, to where I could, replace my income and also free up some time to, be there, with my wife and for my wife. So I did that. I quit. And, hindsight, it was the best decision I ever made. So, there was that, immediately, no paycheck coming in. There was that fear of failure, and I went all in. So um, what I did my first year is, there wasn't enough rental income to support my income, so I started buying and selling, wholesaling. I was basically, flipping some contracts, securing deals, passing them on to other investors. I linked up with a good friend and mentor of mine at Acre. I was working some of his dead leads, converting them, making catching some fees, and it was good because they were leads that he would otherwise just throw in the trash. So I would chase those leads down. I would make some money off of them. He would get paid, I would get paid. There was a split that we had in place, and I did that for almost a year, where I was just wholesaling houses. It's very common now. There's a lot of wholesalers out there, but that's how I made the transition. And then as I got to the point where I quickly replaced my income, I realized that I'm wholesaling all these houses and I'm leaving a lot of money on the table. So I started, instead of selling all the houses, I'd keep one or two, I'd do the rehab, and I'd sell it retail. So over time, over that next year or so, I transitioned into uh, uh, doing more flips, what they call flips now. So instead of wholesaling everything, I'd buy it, get it funded, I'd do the remodel, and I'd sell it retail. So that, progressed into another business model in itself, where I transitioned. I was starting to make more money and do more deals, and started keeping and renovating more houses than I was wholesaling. And I did that, in we're going into like 2012, 2013, and got involved in a number of projects in Lawrenceville, Pennsylvania. And if anybody knows, which I'm sure most of you know, the market, 2012, 2013 was a really, really good time to get started in Lawrenceville. I'll never forget the first house that we renovated to sell in Lawrenceville was on Plummer Street. So we bought it, did a full gut renovation, put it on the market, listed it for 175,000, and at the time we're getting ready to do the listing. I'm like, who the heck is going to pay 175,000 to live in Lawrenceville? Well, fast forward, that was 2012. Now we're 2021. That same home, listed today would be 550, 600,000. So the market has grown tremendously in Lawrenceville and similar pockets in the city. So we did that. Did a number of those projects in Lawrenceville and became very, very active in that part of town. And I don't know what year it was, maybe 14, 15, something like that. I had the opportunity to, an agent brought me some lots, to some vacant lots. And I'm like, I'm not really a builder, but, it looks like there's some money here. So went down that path, bought a couple of lots, went through the planning and approval process, built some homes. There were some challenges, some learning curves along the way, but that started my path as a builder. We ended up built a couple of houses in Lawrenceville. Challenges, bumps in the roads along the way. Dealing with a builder is totally different from dealing with a general contractor. Dealing with the permitting and approval process on new construction is totally different than pulling a general building permit for a remodel. So a huge learning curve there, but got through it. Did really well on some projects. Fortunately, the market kept rising in Lawrenceville. So even though we're coming across some challenges, some bumps in the road, some things that were missed, it's like we're okay because the market kept rising as we're doing these projects. So fortunately, that all worked out. And then started growing and progressing, always continually growing and progressing, trying to do things bigger, better, and more so better. So that transition from building an infill house here to building 3 or 4 homes here to buying a chunk of land here, doing a land assemblage deal here where we're going to build 10 homes, we're going to build 14 homes, we're going to build 9 homes. So really, over the next couple of years, started, working on some much bigger projects and taking those through planning approvals and execution. And then, what really changed my business was in 2017. So up until 2017, and even through today, the majority of my business is privately funded. So, we work, as I mentioned at the beginning, we work with private and institutional investors to create and manage portfolios. Prior to 2017, bulk of my business was under a debt model. In 2017, I linked up with a very good friend of mine who is a very good friend of mine now and a mentor of mine. His name's John Burley. He taught me the private equity model. And I went out to Arizona. I did some really in-depth, detailed training and mentorships to learn the ins and outs of, financial management, private equity, everything that they had to offer. And, I switched my business model from debt to equity. And what that means is, rather than borrowing money to do these deals, we create partnerships and we work one-on-one with these institutions and the private investors to become a partner in the project or a partner in the portfolio rather than just a lender. So it's a win-win scenario where interests are aligned. Rather than a fixed rate of return, the investment partners get the all the benefits of owning real estate. While my company does all the work involved with the project. So, like I said, in 17, we switched to the equity model, and then also, one of the big reasons why I did that was I was looking at my business over the last 5, 10 years, 15 years, and I'm looking at it, and like many other businesses, there's ups and downs. And fortunately, I just blinders on. We had some tough times. We worked through it. We pushed through it. It's like, we're gonna get there. I'm not going back. I always had this. I always told myself that I'll never forget where I started in that $350 a month apartment, and I'm gonna keep going. I'm gonna keep building my business. But if I got to go back, is what it is. I'll go back. But in 2017, one of the reasons why I made the decision to go into that, in-depth training and mentorships and really go all in and learn the equity model is that was also the time that my kids were born. In 2017, we were blessed with twins, who many of they're very important, the most important thing to me. So, once my children came, or once our children were born, I told myself, like, I can't go back now. I can't fail now. I'm not going back. So, sort of made that transition from doing some speculative stuff, the builds and the developments and the flips, and like, we're still going to do that. We're gonna be very cautious on what we're doing, the projects that we're taking on. But I started thinking more, long-term plays. It's like, we built the business, we have the model. Fortunately, we've done well over the years, but now we gotta look at long-term plays, and we got to get rid of the ups and downs. So when we switched to the equity model, we focused on primary focus is safety and security. It's like, now bulk of what we do is we just buy a bunch of existing single family homes, create portfolios of single family homes where, we have some cash flow, we have some equity, we have some tax benefits, things like that. It's nothing, nothing crazy. It's not, like some of the stuff that we're building, Mount Washington and Lawrenceville and Southside and things like that, where you got, these crazy finishes, rooftop decks, and, super high price points and all that stuff, which the market bears. But there is some risk and some speculation that goes along with those projects. We're more so focused on, just base hits, just single family homes, just creating portfolios of single family homes, creating cash flow, creating the long-term plays. So, in a nutshell, that's where we're at. That's sort of how I started, how we transitioned into the business, and how we grew the business over the years. And my plan and my focus here with this podcast is to just create value and provide value to you guys. But I don't want to take up too much of your time. I know it's a huge commitment to, carve out 20, 30, 40 minutes, whatever it is, to listen, to what I have to say. And I appreciate you guys. I value your time. And, what I want to do is just, have small segments here, provide as much value as I can, and hope that you continue to listen and follow along. And as we grow and progress over the course of this podcast, as I mentioned at the beginning, we're going to talk a lot about real estate and investments because that's what I do. We're also going to talk about entrepreneurship, business, finance, wealth management. Uh, over the course of time, I plan on bringing some guests on here. I have some folks lined up, friends of mine that are business owners, that are in real estate, that are in other businesses, that have said, I want to be on your podcast. I want to be a part of it. So I have some guests lined up. If you guys have a guest that you want to hear from, let me know. Shoot me a message, connect with me, let me know who you want to see on this podcast here. If you have a topic that you want me to cover, let me know. We're going to be here for the long term. I'm a long-term guy, so we're going to be here for a while. If there's something specific that you want me to dive into, let me know. But aside from that, we're going to try to keep this to 20, 30 minutes tops. Each episode, just provide content, provide value, and see where we can go with this podcast. So again, this was episode 1. I thank you guys for listening. I thank you for tuning in. I thank you for taking the time to listen to this. And again, let's just see where we can take it from here. Thank you.